What is up, future CPAs? Welcome to this explainer. If you are a Gen Z accountancy student gearing up for the Management Advisory Services part of the LECPA, well, you're in exactly the right place. Today, we're not just cramming for next week's quiz. No way. We're building a high-yield study guide that's actually customized for how your brain works. The goal here is deep, 3-year retention, so that by the time you sit for the actual board exam, this stuff is completely second nature. So let's dive right into our ultimate masterclass on core CVP concepts and the contribution margin.
Here's our roadmap for today's explainer. First, CVP basics, then the CM engine, followed by CM ratios, CM versus gross margin, assumptions and limitations, and we'll wrap it up with a LECPA rapid-fire review. Let's get to it. Section 1, Decoding CVP Analysis Basics. Okay, let's open up our first mental bucket. Because before you start memorizing formulas, you really need to understand what CVP analysis actually does in the real world, and honestly, why examiners test it so heavily. Cost volume profit, or CVP analysis, is basically the study of how total revenues, total costs, and operating income change when there are variations in things like output levels, selling prices, or costs. Think of CVP as the fundamental engine that managers use for profit planning. Whether a company is figuring out how to price a product, evaluating a brand new startup, or trying to find the absolute best product mix, CVP is the exact model they use to predict the future. Section 2, the contribution margin engine. So now that we know what CVP is, let's look at the core mechanical tool used to actually run this analysis, the contribution format income statement. Now, notice how this is fundamentally different from traditional financial accounting. Instead of grouping costs by traditional functions like, manufacturing versus administrative, it groups costs strictly by their behavior. All the variable costs are grouped together, and all the fixed costs are grouped together. This behavioral view is basically a game changer for managers trying to figure out how profits will be impacted when their sales volume goes up or down. I want you to literally burn these 5 sequential steps into your memory. It's a vital hack for the board exam. Ready? 1. Start with sales. 2. Deduct all variable expenses. 3. That gets you to your contribution margin. 4. Deduct all fixed expenses. And 5. You arrive at your net operating income. Seriously, if you just remember this simple top-to-bottom flow, you will never get lost on one of those crazy multi-step problems on the LECPA. And that brings us to the absolute golden rule of management advisory services. The contribution margin is the amount remaining from sales revenue after your variable expenses have been deducted. But here is the kicker. Its primary job is to eat up fixed costs first. It literally must cover those fixed expenses completely before it generates a single peso of profit for the company. Section 3, Mastering the CM ratios. Moving right along, we need to know how to measure this margin. Think of these next formulas as your essential cheat codes for quickly eliminating wrong answers on the multiple choice section. First up is the unit contribution margin. This is simply the unit selling price minus the unit variable cost. This formula measures exactly how much each individual unit sold contributes to covering those fixed costs we just talked about. So if a local coffee shop sells 1 additional iced coffee, their overall operating income increases by exactly the amount of this unit contribution margin, assuming, of course, that their fixed costs don't change. But, we don't just look at absolute peso amounts. We definitely need percentages too. The CM ratio is just the contribution margin divided by sales. And here's a really great shortcut for you. You can calculate this ratio using the total amounts or just the per unit amounts. Dividing the unit CM by the unit selling price gets you the exact same percentage. It's totally up to you and what data the problem gives you. Let's ground this with a concrete example. Say a company has a CM ratio of 40%. What does that actually mean in plain English? It means that for every single peso of revenue generated, 40 centavos is available to first apply to fixed costs and then eventually contribute to net income. The remaining 60%, that's completely consumed by the variable costs. Section 4, CM versus gross margin. Okay, pay super close attention here, because examiners absolutely love to blur the lines between contribution margin and gross margin. It's a classic trap to test your analytical mastery. The fundamental difference is all about what specific costs are deducted from revenues. Contribution margin subtracts all variable costs, right? Whether they're manufacturing, selling, or administrative. Traditional gross margin, on the other hand, just subtracts the cost of goods sold.
The ultimate difference really boils down to the placement of fixed manufacturing costs. For gross margin, those fixed manufacturing costs are mixed right into COGS and deducted before the margin is even calculated. But for contribution margin, they're treated as a fixed cost and deducted after. Why does this matter? Well, gross margin measures overall competitiveness, while contribution margin assesses the risk of loss by isolating what actually varies with your sales. So whatever you do, do not mix these two up on exam day.
Section 5. CVP Assumptions and Limitations. Look, just knowing the formulas isn't enough for the LECPA. Examiners are going to vigorously test the conceptual limits of the CVP model. You have to know when the math works and, honestly, when it breaks. CVP analysis relies on some pretty strict boundaries. We assume that revenue and costs are perfectly linear. We assume the selling price, the variable cost per unit, and total fixed costs remain completely constant. If a company sells multiple products, we assume the sales mix never, ever changes. And crucially, we assume all units produced are sold, which means absolutely zero change in inventory levels. But here's the catch. All of those strict assumptions are only considered true within what we call the relevant range. Think of this as the specific band of activity where cost behavior patterns actually hold up. Outside this relevant range, well, variable cost per unit might drop because the factory got more efficient, or fixed costs might suddenly jump because the company had to rent a whole second warehouse. Basically, outside this range, the basic CVP model completely breaks down. And because of these super rigid assumptions, CVP definitely has real-world limitations. It is an approximation, not absolute precision. It completely ignores the time value of money. And as any practicing accountant will quickly tell you, trying to perfectly split semi-variable or mixed costs into strict fixed and variable buckets is incredibly difficult in the real world.
Section 6, LECPA Rapid Fire Review.
All right, let's wake up those brains. To really lock in that long-term 3-year retention, we're going to do a little active recall right now. I'll ask a question, give you a second to think, and then we'll confirm the answer. Ready? Think back to the engine we built earlier. At the exact break-even point, where profit is exactly zero, what does total fixed cost equal? It exactly equals the contribution margin. Remember, CM eats fixed costs first. So if profit is zero, CM perfectly consumed the fixed costs with absolutely nothing left over. Okay, next question. What happens to our CVP analysis if inventory levels change during the period, meaning production does not equal sales? Well, the answer is that CVP becomes vastly more complex. The basic models and formulas we just went over become invalid without major adjustments, all because that core assumption that production strictly equals sales has been violated.
Master the margin, conquer the board. I challenge you to practice these core models until that contribution format statement becomes second nature. It truly is the engine of profit planning, and understanding it deeply is going to pay massive dividends on the LECPA. But before you go, I want to leave you with this thought. If CVP relies heavily on a constant sales mix and fixed prices, how would you adjust this model for a company facing sudden, massive inflation? Ponder that for your next case study. Keep studying smart, and I'll see you in the next explainer.